Well, it's another weekend here, and you're watching Capital Market live on Channels Television. I'm Ladi Williams. Let's take a look at how your money performed during the week. Let's get the show started with market numbers from outside our shores. In the United States, stocks on Wall Street closed Friday's session positive across board, but still posted their first losing week in six amid heightened inflation fears. This comes as a fresh inflation reading sent bond yields higher and hit growth pockets of the equity markets. Dow Jones Industrial Average was up 0.5%. S&P 500 gained about 0.7%, while the Nasdaq Composite rallied by 1%. For the European equities markets, it closed the day slightly mixed Friday as global investors assess recent high inflation within the Eurozone and corporate earnings. UK's FTSE 100 index dropped by 0.49%, while Germany's DAX went up 0.07%. France's CAC index gained about 0.45%. And across Asia-Pacific, the markets ended Friday earlier with a strongly positive sentiment on gains recorded by tech stocks. Japan's Nikkei 225 gained 1.13%. Hong Kong's Hang Seng index finished the trading day 0.32% higher, while mainland Chinese stocks closed the day higher, with the Shanghai Composite rising 0.18%. And at the unlisted securities market, trading at the NASD OTC Securities Exchange closed the week with a positive percentage return for the week. The NASD's key index was higher by 1.57% at 757.16 points, while its capitalization rose by the same margin to 625.55 billion naira. Total volume of securities traded during the week dropped by 71.68% to 1.07 million units. The total value of securities transactions during the week also dropped by more than about 51% to 25.82 million naira in 47 deals, which was higher by 9.30% when compared with last week. And was mixed trading continued at the secondary bonds market as investors remained on the sidelines waiting the outcome of a Nigerian Treasury bills auction for a clear direction on fixed income yields. Average yield across the benchmark curve declined at the short end following demand for the March 2025 bond, but expanded at the segment as investors sold off the February 2028 bond, while the long end remained unchanged. Elsewhere, activities at the Treasury bills secondary market ended the week on a bullish note as the healthy system liquidity market participants filling unmet bids from Wednesday's NTB PMA at the secondary market and a lack of fresh supply at the OMO primary market supported demand for T-bills. The result, the average yield across all instruments declined to 5.4%. Meanwhile, yields on OMO bills fell by 7.70%, while yields on CBN's special bills dipped by 11.01%. And at the stock market, investors have gained more than 646 billion naira this week, despite recording some amount of profit-taking in 3 sessions. The all-share index remains in the 43,000 level as it gained almost 3% this week, while total value of listed equities remained in the 22 trillion mark, which was propelled into by the telco giants and MTN Nigeria and Airtel Africa. However, in sectoral performance across the 5 key counters of listed equities was mostly negative, particularly the insurance and the banking sectors, while the consumer goods sector was the lone gainer with 0.63%. Nemeth led a pack of 26 gainers, up 12.50%. Cornwell tops a list of 36 losers with a nearly 15% price load shed, while FBN Holdings, Sterling Bank, and UACN are top 3 most actively traded stocks for the week. All right, let's bring in Professor Uche Waleke now, Professor of Capital Market at the Nasarawa State University, KEFI. He's also the pioneer president of the Association of Capital Market Academics of Nigeria. Good to have you on the program.
Thank you very much, Ladi. A very good
Great to have you, Prof. Well, let's start by taking a look at the performance of the equities market this week. The bears, dominated the last 3 trading sessions of the week. What do you think was responsible for this negative market sentiment?
Yeah, Ladi, that's essentially profit taking. if you observed, the market began on a very strong note on Monday, gaining as much as 2.93%. And the positive sentiment continued the following day when we also had, when the equities market printed over 1%, 1.12% gain. So what we now witnessed on Wednesday, Thursday, and Friday, I would refer to as profit taking. Recall that even the previous week, the market fell by about 0.06%, and that was carried over into this week. Even though week on week we are talking about a positive performance of about 2.95%, but you realize that overall market sentiment was negative. Market breadth, of which measures that, was negative. We had 43 losers as against 23 gainers. Of course, at the beginning of the week, we saw strong interest in high cap stocks, MTN Nigeria, Airtel, Africa. That, of course, drove the market. But towards the end of the week, the bears, just as you said, took over, such that the market ended on a negative note on Friday. But the interesting thing is that if you take it week on week, it's still a positive performance, much higher than what we saw, the previous week. And of course, the performance, had the effect of moderating the year-to-date return to about 7.4%, now. Prior to Tuesday, prior to Wednesday, as a matter of fact, it was in excess of 8%. So I see profit taking, a lot of profit taking place, and one should expect that to happen, especially as we approach the festive season.
Prof, it seemed like profit taking actually came too soon.
Well, it's a feature of the markets.
Right.
You don't have, yes, you're bound to get this, bumpy, trend, in the sense that once you have investors think that a particular stock, has gone up so much, of course, the next thing to do would be to try to offload.
Right.
So when, of course, the impression is that equities or stocks are undervalued, you see investors also taking positions. Particularly, if you look at the players, the dominant players in our markets today, they are mainly institutional investors. And institutional investors, many of them are investment savvy. So they know when to take positions and also when to sit on defense, or even when to quit. We still don't have a significant proportion of retail investors playing in our markets today. It's mainly institutional, and the foreign counterparts that also used to dominate the market in previous times appear to have taken the backseat for now. So it's mainly domestic investors and institutional investors who are playing now.
Okay. Well, markets year-to-date return has moderated to about 7.5%. How does this compare with, global stock market performance?
At the beginning of this program, you read out the performance of some global markets. If you also go by Reuters reports, you would find that the U.S. markets, for example, this week has been, you would say, bullish. Both the Nasdaq, the Dow Jones, the Standard & Poor's, all recorded positive gains. And if you go over to Europe, the German DAX, the France CAC, it was only the FTSE, London FTSE 100, that fell. Over to Asia, the Nike, the Shanghai. So these other stocks, these other markets, of course, witnessed positive performance, which to me is a reflection of the fact that the negative impact of COVID, is beginning to peter out, on this economy. So those fears are no more there. Rather, the fear that we are having now is that of the likely response of central banks, to rising inflation in some economies, such as the European economy, for example, the UK economy, where rising inflation is triggering the fear that the central bank may increase rates. In the US, the fear is also there that the Federal Reserve is likely to front load its plan to normalize interest rates. But for now, the global markets have been positive. But the best way to actually compare what we are doing with what is obtaining what's obtained globally at the moment is to look at the Morgan Stanley Capital Index for the world, which, as you know, represents large cap and mid cap equity performance across 26 developed markets. You also have the Morgan Stanley Capital MSCI index for emerging markets that covers 26 countries. So when you look at the performance of Nigeria, the NGX All-Share Index, you compare that with MSCI, whether for developed or emerging markets. Although Nigeria is not listed as an emerging market, if you look at that, the countries listed there, you find Egypt in Africa. It's only Egypt and South Africa. But if you compare, you realize that the Nigerian market is not doing badly. Of course, you know that last year, the Nigerian equities market was adjudged the best in terms of return. And even as we speak, it's still comparing favorably with what's obtained globally.
All right, so what is the outlook for the market in coming week? Inflation numbers for October is expected to come out next week. The MPC is also scheduled to meet later in the month. Do you see these developments impacting the performance of the market?
Ordinarily, that should, but in our climb here, that isn't the case. That hasn't been the case, and that's because if you look at the rate of deceleration in inflation rates, the September figure is 16.63%, and even if we're going to have disinflation, for the month of October, the rate also might not be significant. So the markets, I don't see the markets caring much about that. And even if, that is going to happen, all that will have been priced, in the, priced in the share prices. So I think the market is not expecting any major decline in inflation rate. I also think the market is not expecting any major shift in policy stance, central bank's policy stance. Personally, I don't think that the MPC is going to tinker with the rates when they meet, later this month. And that's because it would appear that the central bank has reached its limits in terms of the traditional monetary tools, which is why the central bank, would appear to be using unconventional means, heterodox measures, as the bank, refers to them, to tackle the issue of inflation. So when you hear the central bank, for example, ramping up interventions, recently the central bank introduced 100 for 100 policy, all manner of interventions, loan to deposit ratio, just to ensure that there is liquidity, in the system and interest rates, could come down. So interventions by the central bank are meant to, in a way, tackle the issue of inflation, especially if they are meant to increase output. So the central bank might not be thinking of dropping the MPR from the current 11.5% or the liquidity ratio from 30% or the cash reserve requirement from the current 27.5%. So I think the rates will be held. And I think that's also the general market impression. And where that is the case, I don't see that impacting the trend in the equity prices. So the market will shrug it off because, as I said, we don't expect any significant change either in inflation rates or in the MPC decision for now, until possibly sometime next year. This is going to be the last meeting of the MPC for the year. So I don't see that impacting the market.
All right, Prof, we'll see how that goes. Our Prof, still sit back there. We'll come back to you after the break. We'll continue the conversation with matters arising in the capital market. Do stay with us. This is Capital Market live on Channels Television. We'll be back in a moment. Welcome back. Well, right about now, let's bring you a recap of some of the happenings within the capital market this week. Well, the Debt Management Office says it will offer 150 billion naira bonds on behalf of the federal government for subscription on November the 17th. A statement released, the DMO mentioned that the bonds will consist of 3 equal tranches worth 50 billion naira each. The first tranche is a 10-year reopening, which will mature in January 2026 at a rate of 12.50%. The second, a 20-year reopening, which will mature by April 2037 at a rate of 16.24%, while the third, a 30-year reopening at the rate of 12.98% to mature in March 2050. And United Bank for Africa PLC has successfully raised $300 million through its recently announced 5-year senior unsecured notes under its $1.5 billion global medium-term note program. The offering, which was announced on November the 8th, was oversubscribed by global investors from Africa, Asia, United Kingdom, Europe, US, and the Middle East. Analysts say the successful issue reflects continuing global investor appetite for UBA's credit and support for the group's Pan-African strategy. Now to our next conversation. The Apex Bank says the decision to grant PSB approvals to 2 major telecommunication firms in Nigeria is in line with its objective of enhancing financial inclusion and the development of the payment system through a secure technology-driven environment. The move, which is subject to fulfillment of certain conditions as stipulated by the Central Bank of Nigeria, is seen as the first step in the process towards a final approval. Well, let's bring back Professor Uche Waleke now to help us make sense of some of these headlines. Well, Prof, would you describe this move as a game changer for the telecom services sector against their financial service sector counterparts, particularly because they'll be running almost the same services like the example we have in Kenya there, we have M-Pesa.
Yes, Ladi, I think overall it's indeed a welcome development, in our country's entire financial system. It's not now going to boost financial inclusion much the same way as the recently launched in-era, will also help. Ladi, as you know, the rate of financial exclusion in Nigeria is very high. The National Financial Inclusion Strategy had planned to reduce that rate of exclusion, to 20% by the year 2020, but that target hasn't been met. So any measure that is in that direction to increase the inclusion rates, financial inclusion rates, will of course be positive for the financial markets, including the capital market. So I think it's a step in the right direction. You just mentioned Kenya, the story of M-Pesa. Part of why the financial inclusion rate is higher in Kenya today is because the telecom companies, have also been brought in. So I think it's time for the banking, industry, to brace up, for the challenge that fintech and telecom companies, are eventually bringing, for the disruption, that will come from the fintech space. So this is something that has come to stay. We are in an era of decentralized finance, and the earlier that point is noted, the better. So I think the idea is not to bring competition to get the telecom companies to compete with the banks, no, but to complement the services of the bank. Remember, the central bank has not said that these payment services banks will give out loans. They're only allowed to accept deposits, and they're only allowed to operate in rural areas, have at least 50% fiscal presence in these rural areas where you largely have the unbanked Nigerians, and that's how it is going to engender financial inclusion. So they are to accept deposits, they are to help people open savings accounts, they are to also invest in government securities in order to ensure, of course, liquidity. As a matter of fact, the guideline says a minimum of 75% of their deposits must be invested in treasury bills and other short-term government securities, just to ensure that they to guarantee liquidity and to reduce the risk associated with taking deposits. And of course, central bank has said that they are not to give out loans. But of course, we know deposit money banks give out loans and make money from such. But payment service banks are not to do so. The central bank has said their minimum capital base should be 5 billion naira. Has also spelled out the capital adequacy ratio of 10% for payment service banks. So I think all these measures are well intentioned. They are meant, as I said earlier on, to reach out to the unbanked in the rural areas. So I think their services will only complement that of the banks. And also, mind you, the central bank has also said that anything they have in excess of their daily operational needs, should be invested or should be placed with deposit money banks. So you can also see that complementarity with the banks. So I don't see them as competitors in that sense, in a negative sense, but complementary. So I think it's a welcome development at the end of the day.
Okay, complementary. Well, in terms of financial ratio, what will be the impact of this license approval to the balance sheet of these, listed telecom sector giants?
Yes, of course, they are meant to operate. The business organizations, of course, they're meant to operate at a profit. They've also been allowed, the central bank has said they've been allowed to pay dividends. They can pay dividends provided, certain conditions are met, provided, for example, their pre-operational expenses, have been taken care of. So to the extent that, they are, going into some business venture, to that extent, we'd also expect them to make profit, and that profit to rub off, positively on the bottom line of the company, as a whole. So for now, it's a tentative provisional license to MTN and the Airtel Africa, and I'm happy the central bank is starting with these two because they are listed on the exchange. And I will also like a situation in which, as a condition to give out these licenses to the other telecom companies, central bank, should require them to list on the exchange before they can also, be issued, this license. I'm only saying it's my suggestion that as a way of incentivizing the other ones, Glo and Nine Mobile, to be part of it, the central bank should, require them to make a move to come and, list, because that guarantees, that has a way of shoring up their corporate governance, transparency, all the positives associated with, listing.
All right, Professor. Well, it remains to be seen how this all plays out, but obviously financial inclusion is the aim. Professor, thank you so much for coming on the program today. Professor Uche Waleke, Professor of Capital Market. Thank you so much.
My pleasure, Ladi.
All right, now let me bring you some forecasts of what to expect from the capital market in the coming week. Analysts expect positive reaction to the flurry of earnings released this week as investors rotate their portfolio towards dividend-paying stocks ahead of the 2021 dividend declarations. They also expect profit-taking activities later in the week as the bears are likely to cash out on the gains across the counters. At the Treasury bills markets, traders expect yields to trend lower in the coming week as investors react to the recent moderation in stop rate at the NTB primary market. A total of 103.8 billion naira inflow is also expected from the OMA maturities next week. At the bonds market, traders maintain expectations of lower average yields in the short term in the face of reduced supply of instruments in the fourth quarter and deliberate efforts by the DMO to reduce the government's domestic borrowing costs. And that's the program for the week. Thank you so much for watching. I'm Ladi Williams. Bye for now.